inflation numbers are in and they have given investors some relief. Retail inflation cooled to an 8-year low at 1.55%, down from 2.1% in June. Wholesale inflation also slipped further to minus 0.58%, signaling broad disinflation. The fall was largely driven by food prices, vegetables and pulses in particular. With CPI far below RBI's tolerance band of 2 to 6%, the central bank cut its full-year forecast to 3.1%, keeping a neutral stance. Inflation is not a problem right now. Growth and earnings momentum will continue to guide the markets in near term. Welcome back to Signal, where noisy markets meet simple, sharp and sound insights for long-term investors. For the week ending 22nd August 2025, the markets ended higher compared to last week's close. The Sensex finished at 81,307 points and the Nifty at 24,870, both posting modest gains. Through the week, momentum was strong. The Nifty even crossed 25,000 points and touched 25,083 on Thursday. Optimism came from expectations of GST reforms, while strong gains in Reliance Industries and banks fueled the rally. By Friday, the rally cooled as investors turned cautious prior to Fed Chair Powell's remarks and fresh concerns over global tariffs. Sector-wise, IT and financials dragged the indices lower towards the end of the week, but domestic institutional buying kept the sentiments, and that's despite foreign investors' profit booking. So, what does this tell us? Despite Friday's pause, the markets closed the week in green, underscoring how domestic optimism can outweigh short-term global caution. Mutual funds continue to hold steady ground. Equity mutual funds saw robust inflows in July 2025, with SIP contributions hitting fresh highs. Retail investors are staying disciplined by using SIPs to navigate market volatility. Interestingly, tax-saving oriented funds or ELSS were in focus because many investors have started thinking ahead. And here is a quick thought. If you envisage that for financial year 2026, you will be required to make ATC contributions or tax-saving contributions, then why not consider structuring an SIP into ELSS to avoid last-minute strain and also rupee cost average your contributions? We have provided a full breakdown of AMFI's mutual fund data for July 2025 in Signal Episode 3. Why not check it out? For strategy of week, let's dive into ELSS. ELSS stands for Equity Linked Savings Scheme. It is a mutual fund that qualifies for tax deduction under Section 80C for a contribution up to 1,50,000 rupees. Just like your contributions into NSC, PPF or insurance premium. And what's unique about ELSS? ELSS invests in equities unlike other tax-saving instruments. It has the shortest lock-in period of 3 years. It offers a potential to earn higher long-term returns compared to traditional fixed options at 7 to 8% per annum. And if you choose to stay beyond 3 years, then you benefit from compounding power of equities. ELSS is not just about saving taxes. It's about building long-term wealth with discipline without compromising on long-term liquidity. As you can see, National Savings Certificate and Sukanya Samriddhi Yojana are safe and government-backed, but they come with long lock-ins and returns that hover around 7 to 8% per annum. ELSS, on the other hand, has a short 3-year lock-in and the potential for much higher long-term returns, though with equity market risk. The choice really comes down to what your goals are and what is your risk appetite. Whether you want absolute safety or want to build long-term wealth while saving taxes? Meet Sanskriti. Sanskriti is one of our recently onboarded client. Like many salaried individuals, Sanskriti would rush to buy insurance every March just to save tax. In her own words, tax तो बच जाता है मगर पैसा अटक जाता है. So, what was the problem with that approach? Those insurance policies locked her money for 10 to 15 years, delivered modest returns, and left her overinsured. Some of her colleagues invested in NSC or Sukanya Samriddhi Yojana. Safer? Yes. But again, money was locked in for a long period of time and returns were barely above inflation. And how did we help? In need analysis, we found that she was already overinsured and had no further need to buy another insurance policy. Instead, she needed an option that would not only save tax for her but also build long-term wealth. And we did not stop there. We created a power strategy called Sanskriti Autopilot Tax Saver. Sanskriti will be investing 12,500 every month for next 3 years in ELSS scheme. That will be 4,50,000 rupees over 3 years out of her pocket. During the first 3 years, she'll continue to contribute and let her investments grow. From 4th year and onwards, Sanskriti has choice to make her contributions either from her budget or out of her portfolio. The key point is she has choice, flexibility and freedom available only with ELSS compared to other options. Eventually, she may choose to contribute out of her budget, but ELSS provides her flexibility and control to adapt to her changing circumstances. Now that brings us to quote of the week. Quoting Robert Kiyosaki, it's not how much money you make, but how much you keep after taxes. Meaning, true wealth is not just about earning more, it's also about keeping more. Tax efficient investing ensures your money works harder. Now that brings us to the wrap up of Signal episode 4. Inflation is cooling, market is resilient, and ELSS shows us how tax saving can be wealth building too. We are building a strong community of engaged, enlightened, and empowered long-term investors. If you're one of them, why not like and subscribe us and tell us in comments what's your tax effective strategy?